Trading without a game plan is like driving around hoping that you end up at your destination, not using any directions. It just doesn't make any sense. So the goal of this video is to walk you through 5 steps on how you can create a trading game plan for 2024. And then at the end of the video, I'm going to walk you through a specific example so that you can grab what works for you, modify what doesn't, but hopefully add a little bit more structure to what we're trying to do out there, because the markets have a lot of variables and you should not be an unknown variable because you move around haphazardly. It's very difficult to make money that way. What's up, everybody? Erik here from ES Invests, and I'm going to walk you through all of this in detail. But first, we got to start with a disclaimer, because I am just a dude that is talking online. I'm not affiliated with Barchart in any way. I am friends with them. I love their products. I use them myself. So I like creating some content with them. So disclaimer aside, let's get straight into the details. Here are the 5 steps that we're going to talk about. The very first one is begin with the end in mind. This is from Stephen Covey's 7 Habits of Highly Successful People. And this is pretty self-explanatory, but you would be shocked at the number of people who just start trading and they don't think through this. So what we're going to do in this step is create a long-range goal, maybe 5, 10, 20 years down the line. And then we're going to create smaller incremental annual targets and sub-annual targets so that we can make sure we're moving along the correct path. Again, I'll get into an example of doing this in just a second, how you can think about it. Notice here I say be careful. Why would I say be careful? Well, really, you got to be careful in the markets anyways. But the reason why I'm highlighting be careful here is because sometimes people get too wrapped around the axle on their monthly targets. And what that means is, let's say you're targeting 1% return per month. If you are at 0.8% return for the month, there's 2 days left. Are you going to kill yourself trying to get the remainder of the return that month? Most people try. Unfortunately, it's a bad approach. The reason why it's a bad approach is because we are using these things to keep us moving in the correct direction. But the reason why we got to be careful is sometimes people overemphasize any one single goal. They're like, crap, I got to make 0.2% of my account in the last few days. Otherwise, I completely fail as a human being and nothing's going to work ever again for me. So I'm going to throw all of my account into this position to try and make it work. Terrible, terrible approach. So the way to think about these interim objectives, monthly, weekly, whatever shorter term time frame sub-year that you think about, is these are guide rails to make sure that we're moving in the correct direction. So what this means is, let's say your goal is 1% per month. After month 1, you come in at 0.8%. Okay, a little bit slow. Next month we come around and you come in at 0.6%, moving in the wrong direction here. After those 2 months pass, it's telling you something. Either what you're doing is not fitting the market, or what you're doing is completely misaligned with what your expectations are. This is highlighting to you that there's a problem somewhere, but this does not mean that this is a great time to throw all of your account at something in the hopes that it magically starts to work. It's a pretty bad approach. Now, what are we going to reference as we're doing this? Simple. Ideally, you already have tracking mechanisms in place. This is something like a trading plan, a trading log. I talk about these documents all the time with my community because for me personally, started trading in 2007. In the first few years that I traded, I didn't really have anything tangible to look back on to see what was working, what wasn't working, what worked in what conditions, what worked in other conditions, because I didn't track anything. So if you do have this, that's fantastic. That means you can look back at 2022, at 2023, see what worked in what market conditions. Because if we take a look at what the market has done over the past year, you can see some pretty distinct things here, such as some sectors really performed well. Some sectors, cough utilities, have not performed well at all. This is a really important process because then you can say, okay, maybe if one of my strategies is a directionally leveraged sector rotation strategy that I'm trying to play ratio call diagonals. If you're doing that, I probably don't want to do that in utilities. I probably want to do that in something that's performing much better, like consumer discretionary or tech or information technology, something like that. So the idea here is to have an idea on what you can do in what market conditions, what fits the best, and then to reference actual data to make that decision. Now, broad market assessment. This kind of goes back to what we were just talking about, but it goes a little bit deeper still, and Barchart has a ton of fantastic tools to help you get there. So things like this down here, the percentage of large cap stocks above their moving average. You can see the way that this trends. You can also use another really cool tool that they have, which is under the market momentum, and you can look at what's advancing, what's declining writ large. These kinds of things can give you some indication on how things are moving in the near term. And if you're familiar with some of the content I've recently done with Barchart regarding the COT report, this is another great tool to assess how the market is positioning. All of this matters because the way that you think about the current market conditions is going to inform what you want to use, what in your toolkit best fits the current market conditions. And then the last step in this process is revise. As you go through and collect occurrences, data samples, you will see what's working, what's not working. A great example of this is through 2023, I had to make some changes to a few things I was doing. The first thing is when I was trading earnings releases, I typically try to use like a short straddle to capture variance risk premiums more purely. However, I was finding that wasn't working very well. So then I went back and looked at other periods where earnings were reacting differently frequently than what was being projected via the options. And I said, hey, in this circumstance, using short strangles worked better for me. And I knew not to go to something like short iron condors because of the data that I was able to reference. So all in all, you have to stay receptive to what the market's doing. Okay, so now let's talk about that example that I was referencing. Here we have Ted. Ted is a young guy, did a great job saving, and he's starting with $20,000. His goal is to get to $1 million in 20 years. So he plots that out using a compound growth calculator. This is probably one of the most utilized tools that I have in my toolkit because it keeps me on track with where I'm trying to go. So in this case, Ted has been trading for about 3 years, and Ted thinks 12% per year is a fair run rate for him. And at $950 saved per month on average, some months we might be a little bit behind, some months we might get a bonus and be able to save some more. This will get them to their target. We've just created our long range goal and our supporting annual targets. So the next thing we need to do here is set those interim objectives, which is breaking down these annual targets into smaller targets. None of this is rocket science. However, most people neglect going through this process because now here's another thing we can determine. Remember back when I was saying we're pursuing 1% per month, but maybe we get 0.8%? That might not be the end of the world because maybe instead of going out 2 nights that month, they can then save that money to increase their savings a little bit and keep them on track. So the idea here is to pay very close attention to what your long range goal is, because unfortunately, a lot of people have this idea that they want to achieve, but there's nothing to connect the dots to get them there. That is the whole point of creating these kinds of plans. So for 2024, you might be thinking about the Fed interest rate environment. There's a lot of themes you can build off of that might funnel into how you intend to trade 2024. But from there, it comes down to your ability to look at your toolkit to see what works in this kind of environment to make as much money as you can. So as always, if you have any questions, throw them down in the comments. Love chatting with everybody. Looking forward to seeing you all in a future video. But until next time, be an outlier. We'll see you guys later.